There are two kinds of people. The first, they get an extra $1,000 and rush straight to the mall. New sneakers, fancy bag, a night out that burns fast. The second, they take that same $1,000 and plant it, water it, grow it into something that pays them over and over again, even when they're asleep. So the question is, which one are you? Because in this video, you're going to learn exactly how to turn your first $1,000 into a money-making machine, not a side hustle, not some trendy business idea. I'm talking about real assets, the kind that create cash flow, passively. We'll break down what to invest in, how much income to expect, and how to build wealth without chasing hype. If you're in the US, just starting out, or trying to escape the paycheck-to-paycheck cycle, then stick around. Because this video might change your whole mindset. Let's get into it. All right, let's clear something up right now. When I say invest your $1,000, I'm not talking about launching a business, building a brand, or starting a dropshipping store. That's a whole different game. What we're doing here is putting that money to work. So instead of you grinding all day to earn more dollars, your dollars are out there grinding for you. The goal? Cash flow. Real, consistent income that gets sent directly to you while you focus on other things in life. Let's say you put that $1,000 into something like a stock. Now most people will say, cool, I hope it doubles someday. But you're playing smarter than that. You want something that pays you regularly, something that says, thanks for owning a piece of this company. Here's your share of the profits. That's called a dividend. And it usually shows up every 3 months, straight into your account. Think of it like this. You own a share of McDonald's. You're not flipping burgers or working the register, but you do get a slice of their profit pie because you're a part owner. And the more shares you hold, the bigger your slice. Now here's where it gets interesting. You can stack this income. Year 1, your payout is small, but next year it's bigger, and the year after that, even better. Eventually, you can live off these payouts without ever having to sell the investment. That's the power of building cash flow. But hold on. Not every stock works like this. Some are more risky, some more stable. So let's dive into 3 different types of assets you can get started with right now. They each come with a different risk level and return potential. Ready? Let's break down your first option. Let's start with something a little bold. Ever heard of earning money from land you don't even work on? Sounds wild, but it's real. There's a kind of investment called a royalty asset. Here's how it works. Imagine there's land sitting above a pool of oil or gas. You don't drill it. You don't manage it. You don't even step on it. You just own the rights. And every time an energy company pulls something out of that land, they owe you a cut. That's right. You collect royalty payments just for holding that right. There are specific companies called royalty trusts that let you invest in this exact model. You buy into the trust, and in return you get paid out a portion of what that land produces. Now here's the part that excites a lot of investors. These kinds of assets often pay out 5%, sometimes even 10% per year, in cash. So if you put in $1,000, you could earn $50 to $100 a year just in payouts. Not bad, right? But here's the catch. These are not long-term growth machines. They don't build new products or expand into new markets. They just pump and pay until the oil dries up. Once it's gone, so is the cash. You've also got price swings to deal with. When oil prices drop and your payouts can shrink fast. And when prices rise, sure, you earn more. But the ride is bumpy. So yes, the rewards can be big. But the risks? Also real. If you're okay taking on a little more risk with your first $1,000, this could be worth looking into. But just remember, royalty-based assets are like ticking clocks. They run on what's underground. And when that runs out, game over. So weigh it carefully. Now, if you're the kind of person who'd rather sleep peacefully than ride the ups and downs, this one's for you. Let's talk about something much safer. Something that pays you on time and no matter what the market's doing. That brings us to a category called cash equivalent ETFs, or what some people call income-generating funds. Here's the idea. Instead of lending your money directly to a company or startup, you're backing a structured fund that focuses on highly stable short-term debt. Think government-level or AAA-grade assets. Short-term, low-risk, and built for stability. Now, some people do this through direct government bonds, but we're skipping that. Why? Because we want flexibility, we want liquidity, and we want access, all through the stock market. There are ETFs out there, like SGOV and SHV, that give you exposure to these types of income-generating assets. And what do they pay? Right now, somewhere around 4% to 4.5% annually. That's $40 to $45 a year on a $1,000 investment. Not huge, but it's steady, predictable, and backed by some of the most secure instruments in the financial world. Another bonus? In most cases, the income you earn from these ETFs is exempt from state and local taxes. That's more money staying in your pocket. But let's be clear. This is not a growth play. You're not here to double your investment. You're here to preserve it, earn some income, and keep your risk level very low. This is perfect if you're just getting started, or if you're building the safe side of your portfolio. So if the idea of losing money keeps you up at night, this option gives you income without the stress. All right, now let's land somewhere in the middle. Not too risky, not too safe. Just a solid balance between income and long-term growth. We're talking about dividend-paying stocks. These are companies that make real profits and share a slice of that profit with people like you, their investors. Here's the beauty. You don't need to run the business. You don't need to manage anything. You just own a piece and get rewarded for it. Some of the biggest names in the world, companies like McDonald's, Coca-Cola, and Procter & Gamble, have been doing this for decades. They make billions every year, and after paying their expenses, funding future growth, and keeping a rainy day stash, they take a chunk of their profits and say, "Hey, investor, thanks for being with us. Here's your share." Now, this is usually paid out quarterly, every 3 months. But here's where it gets tricky. You've got to pick the right companies. Just because a stock pays dividends today doesn't mean it'll keep doing it forever. Businesses evolve, markets shift, even big names can crash. So unless you want to research companies full-time, there's a smarter way to do this. Enter dividend ETFs. These are funds that specialize in holding dozens, sometimes hundreds, of dividend-paying companies. Let me give you 2 powerful examples. 1. SCHD. 2. No BL. SCHD is managed by Schwab. It includes a wide mix of high-quality U.S. companies that consistently pay dividends. And right now, it's paying about 4% annually. So with a $1,000 investment, you'd earn about $40 per year. NoBL takes a slightly different angle. It only includes companies that have paid, and increased, their dividend for 25 straight years or more. That's what they call a dividend aristocrat. And while NoBL's dividend is a bit lower, around 2% per year, it's built for long-term reliability. Here's why people love this approach. You're earning passive income now, through dividends, and potentially growing your money over time, if the value of these companies increases. It's not about chasing quick wins. It's about building a foundation that pays you now, and can pay you more later. Now, yes, these are still stocks. If the market crashes, your investment might dip, and dividends can get cut in bad times. But compared to single stock bets, dividend ETFs spread the risk and focus on quality. If you're looking for that sweet spot between growth and income, this is it. Okay, so now you've invested your first $1,000. You picked an asset. You're earning a little income. But let's be honest, $40 a year won't change your life. So here's the real question. How do you grow it into something meaningful? Let me break it down into 3 powerful steps. This is what separates those who dabble in investing from those who build real wealth. Step 1. Be consistent. No matter what. Don't just invest once and call it a day. Make it a habit. $1,000 this month? Great. Can't do $1,000 next month? No problem. Do $500 or $100 or even $50. Whatever you can set aside, just keep doing it. Every month, every paycheck, no matter what. Consistency is what fuels the compound effect. And trust me, over time, that small snowball becomes a financial avalanche. Step 2. Reinvest everything you earn. This is the one people skip, and it's a mistake. Let's say you earn $40 from your dividends or payouts. Instead of spending it on coffee, dinner, or random stuff, reinvest it. Put that $40 right back into the same asset. Buy more shares. Grow your position. Because when you reinvest your income, your money starts to make more money. And that new money starts working for you too. It's like building a machine that prints dollars, then using those dollars to build another machine, and another, and another. That's how wealth multiplies. Step 3. Grow your contribution over time. Got a raise at work? Throw a little extra into your investments. Picked up a side gig? Use that income to buy more assets. Got a bonus or refund? Feed the machine. Every time your income grows, increase how much you invest. Why? Because your lifestyle will try to grow too. You'll want to spend more. Upgrade, enjoy. But if you lock in those gains by investing first, your future self will thank you. Big time. Now, let's talk real for a second. In the beginning, you won't feel the difference. You'll be putting money in month after month, and the results? Tiny. That's where most people quit. But here's the deal. If you stay committed for 3 years, 5 years, 10 years, that's when things change. You start to see real passive income, real growth, real freedom. It's slow at first, but the snowball effect kicks in, and before you know it, you've built something powerful, something that pays you every single month, whether you're working or not. That's the dream. That's the mission. And the best part? It doesn't require a fancy job or a business degree, just a mindset shift. Spend less, invest more, stay consistent, and repeat. So here's the truth. Most people get an extra $1,000 and think, let me buy something flashy, something fun. But the ones who really win? They buy freedom. They use that money to buy income. They plant a seed, and they water it. Because that small seed, it turns into a tree. And one day, that tree starts dropping fruit, over and over, without you lifting a finger. It doesn't happen overnight. It doesn't happen in a month. It takes commitment, focus, patience. But if you start now, even with just a small amount, and you stay consistent, you'll look back one day and realize that was the moment everything changed. You stopped trading time for money, and you started building a system, a quiet, steady engine, and that works while you sleep. So whether you choose a royalty-based asset, or go the safe route with treasury ETFs, or build through dividend-paying stocks and funds, just start. Even if it's $50 a month, start. Invest regularly, reinvest what you earn, and grow your contribution over time. This is the strategy the wealthy have used for generations, quietly, without hype, without shortcuts. Now it's your turn. If you got value from this video, give it a like. Drop a comment and tell me, what's the first asset you plan to invest in? Subscribe for more content like this, where we break down real strategies to grow your income, build your future, and take control of your money, one step at a time. You don't need to be lucky, you just need to be consistent. Thanks for watching, and I'll see you in the next one.